Okay, can you go to this question, please? In the revision kit, it's on page number 13, FLG Company, year 2008, June. The question deals with two areas of working capital management, receivable management and inventory management. The question starts with this: FLG Company has annual credit sales of 4.2 million. Have you found that question? Right. Can you just go through the first paragraph, please? FLG Company has annual credit sale of 4.2 million and cost of sale of 1.89 million. Current assets consist of inventory and accounts receivable. Can you please underline that word? Current assets include two items: inventory and receivables. Current liabilities consist of accounts payable and overdraft. The composition of current liability. Tell me normally, what can fall under current assets of an organization? Inventories, receivable, bank, prepayments. But in this case, as far as this company is concerned, their current asset include only two items: inventory and receivables. Similarly, liabilities, current liabilities consist only two items: accounts payable and overdraft. Have you got that point? Overdraft with an average rate of 7% per year. So this is the finance cost, looks like. The company gives 2 months credit to customers, meaning our average collection period is 2 months, and is allowed on average 1 month credit by the suppliers. So meaning the payable period is 1 month. My accounts receivable days, 2 months. So I am told the payable days, 1 month. Okay, let's carry on. It has an operating cycle of 3 months. Who can tell me how to get the operating cycle? The formula is this: 2 receivable days plus the inventory days, the unknown, minus 1 should be equivalent to 3, correct? So we can find this X accordingly in case needed. It should be what? 2. So basically speaking, in this paragraph, examiner has told the company wait 2 months to collect money from the customers, and the company on average taking 2 months to sell their inventories. It's not explicitly stated, but we have worked out. Inventory days is 2 months, and the company takes around 1 month to settle their suppliers. And they have current assets and current liabilities. Current assets include inventory, receivables. Current liability includes payables and overdraft. You have been given some other information as well. Current ratio is 1.4. Current ratio is what? The ratio between current assets and current liability, isn't it? So what the examiner says here is, if your current liability is 1, current asset should be 1.4. That's the ratio he speaks about. Suppose if your current liability is 100 million, suppose your current asset should be 140 million, right? In other words, your current asset is 40% more than the current liability, alright? And the cost of long-term finance is 11%. What is the cost of short-term finance? 7%. Bank overdraft interest is given. Now, if we fail to finance some of the assets through the short-term sources, the next option is what? Go for the long-term source. To the extent possible, we try to finance our current asset using short-term financing, bank overdraft. But if we in case, if we don't have enough short-term facilities, the next option is go for the long-term. So having understood the scenario, let's move on to the question. Discuss the key factors which determine the level of investment in current assets. Can I say in simple word, what decides the size of the current asset? Whether you want to invest more or less in the current asset, what factors decide? Number 1, the availability of finance. If you have easy financing, for example, your suppliers are allowing a good amount of trade credit, so you love to invest more and more on current asset because you have cheap finance available. So the first point is, availability of finance. If you have enough finance, like you go in this order: trade credit. We always love to finance our current asset through trade credit. Tell me the reason why. There is no interest. Trade credit is free. Suppliers don't charge interest. Next, you look into bank overdraft, very popular source to finance short-term assets. And then if you don't have bank overdraft, go for short-term loans. If not, as the last resort, go for some long-term financing options. This is the order in which your current asset should be financed. But my point is, in answering this question, if you got plenty of financing opportunities available, you love to invest more and more on current asset, right? Because you have enough financing options available. So one of the factors that decides the amount of investment in current asset is the availability of finance. What else? Pardon? Attitude to risk is a wonderful point. Attitude to risk. You see, if you want to play safe, I would say always try to have a good amount of inventory. If you want to play safe, because don't take the risk of running out of inventory, running short of inventory. Yeah? You don't want to take risk. I mean, you're so confident on your brand, you're so confident about the brand of the product, and you say no to the customer. Still you have the confidence the customer will come back to us. We don't have the risk of losing the customer because our brand is so powerful. So if we have such confidence, you can take the risk of having low inventory or no inventory, right? If your product is not that popular, don't lose a single customer. So have enough stock. The point is, if you want to take risk, you can still take the risk. But you have to remember, there's a chance of losing the customers. Otherwise, I would say, have enough stocks with you. In other words, there's something called buffer stock, safety stock. Some organization always keep certain amount of inventory, and the stock will never fall below that. And that's the fixed investment in the inventory. They'll never take the risk of running short of inventory, right? Because they know that if you lose the customer, the competition in the industry is so tight. If you lose the customer once, the customer goes to the next shop, and he won't be coming back. Now, there are two types of risk attitudes: risk averse, or I would say conservative, optimistic. What do you mean by conservative? Play safe. If you want to play safe, you like to have enough inventory. You have to invest a good amount in stock. If you want to be optimistic, you can try your chance of running short of inventory. And of course, I always welcome a company maintaining low level of inventory, because you can save a good amount of storage cost, warehouse cost, storekeeper salary. If you want to play safe, conservative, you need to have a big amount of current assets. Otherwise, try to run with low level of current assets. Same thing applicable to receivables. If you are so confident on your product that you won't be losing the customer, sell everything on cash. Your bargaining power is very high. Your product is demanded by the customer. So sell on cash. No need of building receivables. No need of having debtors in your balance sheet. Sell everything on cash. Attitude matters. What is the third point? Type of the business. I would say, yes, nature of the business operation. Service versus production organization. Trading versus manufacturing organization. If you are a trader, you have to invest only in the finished goods. If you are a manufacturer, you have to invest in raw material, work in progress, and finished goods. So your size of the inventory being a manufacturer is always high. There's a difference between retailer and wholesaler. Most of the retailers don't sell on credit. It is the wholesalers who sells on credit, right? So it depends on the nature. Service organizations don't build up stock because they are selling intangible assets. So those factors, type of the business, nature of the business, decides the amount of investment in the current assets. So you have to come up with this sort of an answer. What factors decide the investment on current assets? So have you answered that? Discuss the key factors which determine the level of investment in current asset. Understood that? Pardon? Cost of finance. Wonderful. Excellent point. Shall I club that point with the first point, availability of finance? Now, of course, if this finance is cheap, the availability is very high, isn't it? One of the factors that decides the availability is what? Cost of financing. Good point. Why you prefer trade credit? Finance cost is zero. So impliedly we consider the cost of financing, right? But wonderful point. You can highlight that. Come to the next one. Discuss the ways in which factoring and invoice discounting can assist in management of accounts receivable. My notes, I published that video. Did you receive that? Okay, so you can get the difference between factoring and invoice discounting. Yes, and we have done that enough. So I'm just quitting that area. Calculate the size of the overdraft. Fine, here the question comes. Calculation part. You're going to get a good 6 marks for that. Calculate the size of the overdraft of FLG company. Remember, your current liability includes payable and overdrafts. So maybe if you know the total current liability, if you remove the payables, you may get the overdraft, right? So we need to work out the size of the overdraft, and you are asked to calculate net working capital. You see the difference between working capital and net working capital. If I say calculate working capital, you take inventory plus receivable minus payable. But when I say net working capital, is total current asset minus total current liability. We got three requirements in this question. What are the three? Size of the overdraft, net working capital, and total cost of financing. Fine. Now, we need to find out overdrafts. You have to do some initial working to answer this question. So can you find out the size of the debtors with the help of this information? Wait. I'll give you time to do that. Let's plan it off. You got your sales and the receivable days, right? So which means you can find out size of the receivable. We know your cost of sales. How much is it? 1.89. And what is the inventory days? 2 months. So we can also work out size of the inventory. The ratio between current asset and current liabilities 1.4. So now we can find out, having known the total size of the current asset, we can find out the total size of the current liability. Again, we know cost of sale and the payable days. How much is it? 1 month. So can't we find out payables? So if you remove payables from current liability, you get the overdraft. So from where we start now? We'll work out receivables, payables, inventory. Shall we work out first receivable and inventory? Current asset include what? Inventory and receivables. So you got to work out inventory and receivables. Current liability include payable and overdraft. So I'll start one by one. So let's work out inventory. What's your cost of sales given in the scenario? 1.89. 315. Work out receivable days. I am told how much the sale is. 4.2 million. 2 over 12, 700,000. And let's work out your payable. 1.89 into 1 by 12 gives you how much? 157,500. So let's take your inventory is 315,000. Receivable is 700,000. So which means what is the total current asset? 1,015,000. This is your total current asset. And of course your payable is what? 157,500. We don't know overdraft. That's the question. Examiner has said the ratio between current asset and current liability is 1.4. Meaning if this is 1.4, this has to be 1 in size. I can do a simple math. I divide this by 1.4 to get this answer. So let's divide this by 1.4 to get the total current liability. 725,000. So now we can easily find out the size of the overdraft, isn't it? Because we know the total size of the current liability, which is 725,000. We have payable 157,500. From 725,000, 157,500, 567. So this is your size of overdraft, isn't it? This answers the first part of the question. In part 1, one part is to find out overdraft. We have worked out 567,500. The second part is net working capital, which is simply current asset minus current liability. Your current asset is 1,015,000. Current liability is 725,000. So you get your net working capital 90,000. Clear? Have you understood this part? The last part is what? Finance cost. Now, take the total current assets for a while. Which include receivable and inventory. So you got 1,015,000, right? And this is what your total current asset. Now company can use various sources to finance the current asset, but what is the best source? Payables. How much payable have you got? 157,500. Because your suppliers have agreed 1 month credit. So the maximum size of trade credit available is only 1,575,000, and part of this current asset is financed through overdraft. How much overdraft available? 567,500. The balance is how much? That is your net working capital, right? What is the finance cost of this? 0. And the finance cost of overdraft? And the balance you should finance, the maximum overdraft available is 567,500. So the balance should be financed through what? Using the long-term sources. What is the finance cost of long-term sources? So now you can work out your total finance cost. Here of course 0. Trade credit is free. How much overdraft interest you have to pay? 567,500 into 7%, correct? How much overdraft interest? 397,25. And how much interest you should pay on long-term borrowings? You have done these 3. A, B and C. Answered. Part D is from which section? Inventory, isn't it? Fine. Read that question. FLG company wishes to minimize its inventory cost. Annual demand for a raw material costing 12 per unit is 60,000 units per year. Inventory management cost for this raw materials are as follows. What is the ordering cost? 6 per order. And the holding cost 0.5. The suppliers of this raw material has offered a bulk purchase discount of 1% for orders of 10,000 units or more. If bulk purchase orders are made regularly, it is expected that the annual holding cost for this raw material will be 2 per unit per year. Let's trace out the information. What is the ordering cost? $6 per order. And holding cost? How much? $0.5 per average unit of inventory. And what's the annual demand? 60,000 units. We need to get 60,000 units. This is our total purchasing requirement. What is the purchase price? $12 per unit. This information is given to us. Now, currently, without discount, the company might be like, if suppose for example, if there is no discount given by the supplier, your best ordering size is EOQ. If there is no discount given, how we plan the order size? Based on EOQ formula. Because I proved yesterday, the best ordering size is what? Economic order quantity. We discussed this yesterday. How to derive this EOQ. I showed that graph. If there is no discount offered by the supplier, the best order size is what? EOQ. So let's work out what is the EOQ. 2 demand multiplied by cost of order divided by CH. And I showed how this formula is formed. 2, what is the demand? 6 divided by 0.5 gives you what? 1,200 units. And this, under normal circumstances, this is your best ordering size, isn't it? So if you analyze, if you go with this order size, how many orders you have to go for number of orders? You should divide 60,000 by 1,200. You're going to manage in how many orders? 50 orders. So your total ordering cost, what is the ordering cost per unit? 6, no? So your total ordering cost will be what? 6 into 50 orders, $300. Total holding cost, can you recall the formula? Holding cost per unit multiplied by average inventory, isn't it? So it's $0.5 into 1,200 divided by 2, right? 300. And what is your total purchase price? What is the unit cost? 12. And how many such units you are going to buy? 60,000 units, right? Throughout the year. Cost you how much? $720. Under EOQ plan, your total cost will be, the total ordering cost is how much? 300, another 300, and total purchase price cost you how much? 720, 600, right? If there is no discount, if suppose the supplier has not given any discount, your current order size is 1,200. This is your EOQ, the best ordering size under normal circumstances. If I put order size here and the cost here, this represents what? Ordering cost. Why? Larger the order size, lesser the number of orders. and that brings the order cost down, right? And this represents what? Holding cost. Larger the size of the order, you have to maintain more inventory. This increases the holding cost. Get the total of these two. This will be the total cost, right? Excluding the purchase cost, because purchase cost is going to be the same irrespective of the number of order size. You can get this 60,000 in 1,250 orders or 6,010 orders. Anyway, you're going to buy, 60,000 units. So I'm not bothered about the total purchase cost here. And I said the best ordering size, your EOQ, which we derive from the formula. Now, look at this graph. As per our question, the best ordering size is what? 1,200, right? Now, you may try to calculate this at different rates. Try at, let's say, 1,000 and 2,000. Repeat your calculation of total ordering cost and holding cost. You'll end up with greater than 600. You try anything lower or higher, the economic order quantity, your cost will be high. Here, you get 600, no? If you try anything, you'll get, for example, like this. Yes? So, under normal circumstances, your best decision is what? To go with EOQ. If you are a purchasing manager, supply is not offering any discount, then you go with what? EOQ. But here, it's worth considering. Look at that. Supplier says what? Can you go through that question, please? If there is no discount given by the supplier, your suggestion would have been what? Go with EOQ. And that's what the first question. Look at that. If you come to first question, calculate the total cost of inventory for the raw material when using economic order quantity. Have you got the answer? How much? 720, 600. This is the total cost of inventory if you go with EOQ model. Look at the next question. Determine whether accepting the discount offered by the supplier will minimize the total cost of inventory for the raw material. If you order anything more than 1,200, what's going to happen? Your ordering cost and holding cost together will be more than 600. I will accept this proposal only if the discount that I am receiving. So if that reduction in the price is greater than the extra cost, then you may accept the. So we have to rework. Recalculate ordering cost, holding cost and purchase cost based on the new proposal, that is 10,000, and see what's going to be the total cost. At EOQ, where your quantity is 1,200, we worked out your ordering cost is, can I quickly get that working done once again? 50 orders, gave you how much? 300. Holding cost is, and the purchase cost gave you 720. So we got the total cost of 720, 600. Now if your Q comes 10,000 instead of 1,200, your ordering cost will be now 6 into 60,000 divided by 10,000, right? The maximum number of orders will be 6. So it will be 36. So ordering cost comes down. What's your new holding cost? New holding cost, examiner has said the holding cost is changing, right? How much is it? So it's 2. Instead of 0.5, it's going to be 2 now, multiplied by 10,000 divided by 2. How much is it? Alright, so it's 10,000, but your new purchasing cost is how much? 60,000 into 12 into 99%. Gives you how much? 712. So will you accept the supplier's proposal? No, because the overall cost is increasing. What is the total of ordering and holding cost currently under EOQ? 600, right? If we go with the supplier's proposal of ordering in 10,000 units, 10,000, 36. Change in cost how much? 9,436 increase, right? This is not the desired scenario. This is a disadvantage of accepting the supplier's offer. But we have to compare this with the discount that we receive. So how much discount are we going to receive? On 720,000, we'll get 1% discount, isn't it? That is 7,200. The benefit is not overriding the cost. So how much the net loss of accepting the supplier's offer? 2,236 is a disadvantage. Your conclusion is don't accept. the supplier's offer for discount. So we answered in full. Determine whether accepting the discount offered by the supplier will minimize the total cost of inventory for the raw material. The answer is what? It's not minimizing. In fact, it's increasing the cost by how much? 2236. So you have to conclude accepting the supplier's discount policy is not advisable to this firm. It's not financially beneficial to this company. So we have to go with our existing EOQ plan. That's the conclusion. Everybody understood that? Fine.